Welcome back to Investing Talk Podcast.
Today we're looking at Getty Images. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. What we have with Getty Images is really interesting. It's almost like two different companies financially.
How do you mean?
Well, on the one hand, the core operations are incredibly profitable. Just look at their efficiency. But then you flip the page and you see some, well, serious financial pressures.
Right, that tension, that's what makes it tricky, isn't it? Potential versus risk. So starting with the good news, the operations.
Phenomenal, really. We're talking an exceptionally strong gross margin. It's 73.01%.
73%? Wow.
Yeah. Their TTM gross profit was almost $700 million. $691.28 million to be exact. That tells you they have, serious pricing power. Premium stuff.
Like customers are locked in.
Seems like it. High operating leverage. They basically make really good money on every core sale. The revenue TTM is just under $1 billion.
$946.83 million, yeah. And growing, but moderately. About 2.5% year over year for 2024. So the core engine looks pretty good.
Exactly. The machine itself runs beautifully. But, then you look further down the income statement.
And that's where the picture gets muddy.
Very muddy. Despite those great gross profits, the TTM net income is actually negative, a loss of $115.41 million. That's an EPS of minus 0.28.
Okay, so where's all that gross profit going?
Debt. It's the debt structure. It's just eating away at the operational profit. The leverage on the balance sheet is, well, it's extreme.
That's the big red flag for a lot of people, I bet. How extreme are we talking?
We really have to talk about the high gross leverage. The debt-to-equity ratio as of Q2 2025 was 206.4%.
Whoa, 200%.
Yeah. I mean, you compare that to most stable large caps, they're usually well under 100%. So 206% means they're heavily reliant on debt. Cash flow becomes incredibly important. Critical, really.
Makes sense. It sounds risky. But I thought I saw something about non-cash expenses hiding in that loss.
That's a really key point, actually. That $115 million loss isn't all like cash walking out the door today. It includes significant non-cash and restructuring expenses.
Like depreciation, amortization, that kind of thing.
Exactly. Accounting charges. Things that hit the income statement but don't necessarily drain the bank account right now. So the underlying business, the actual cash generation from operations, might be healthier than that big negative number suggests.
Might be. But that still feels like walking a tightrope with that much debt, right? Relying on accounting nuances or hoping AI revenue kicks in fast. Is management doing anything else about the debt?
That's the gamble, isn't it? Management's immediate plan seems to be buying time. They've been refinancing liabilities, pushing out the maturity dates.
Kicking the can down the road a bit?
Sort of, yeah. But they're betting heavily on cost discipline and, crucially, on making money from their AI strategies. That's supposed to be the real fix for the debt.
And analysts are buying into this.
The consensus seems to be, yeah, they expect a return to actual bottom-line growth in 2026. They see the cost cuts and the AI potential paying off. But for now, all focus is on growth and paying down debt. Don't expect dividends or buybacks anytime soon.
Okay, so that AI piece is clearly vital. Let's talk about their competitive advantage, their moat. There are tons of stock photo sites now, some cheaper. How does Getty defend its turf, especially with generative AI creating images everywhere?
It really comes down to a few things: history, brand, and the legal side. Getty's archives are just massive. Decades of unique content, especially editorial stuff. You can't just replicate that.
And the brand matters.
Hugely. Especially for big corporate clients, media outlets. They need reliability, quality, and crucially, they need to know they won't get sued for using an image. Getty provides that trust. Plus, switching costs are high. Their licenses get embedded deep into workflows.
Ah, the legal angle. So they're leveraging that massive legally cleared library for AI, not just selling pictures, but selling the rights to train AI on the pictures.
Precisely. That's the pivot. They're moving from just selling licenses one by one to licensing the whole dataset foundationally. And they're building AI-powered search into their own platform, too.
And that legal protection, the indemnification, that's key with all the uncertainty around AI-generated content copyright.
Absolutely vital. If you use Getty's licensed images for AI, they essentially back you up legally. That's something fly-by-night competitors or even raw AI generators often can't offer. It makes their data set safer, more valuable.
Okay, that makes sense. And that leads us straight to the big news recently, the Perplexity deal.
Right, October 31st. They announced this multi-year global deal with Perplexity AI. Perplexity is one of those new AI search interfaces that's growing fast.
So Perplexity will use Getty images in its results.
That's the plan. Powered by Getty's library. It's a huge validation, potentially integrating Getty right into the future of how people find information and images online.
And the market reaction was wild.
Completely wild. The stock shot up over 50% during the day. Huge excitement. People are desperate for legitimate ways to invest in AI monetization.
Then, what happened?
It didn't stick. The stock actually finished the day down.
Down after being up 50%.
Yeah, it perfectly shows that conflict we talked about.
Yeah.
Excitement about AI, yes, but deep underlying worry about that massive debt load and whether they can actually execute and turn this into profit. The market's saying, great story, but show me the money.
Wow. Okay, so volatility is the name of the game here. Let's look at the technicals. This is clearly not a stock for nervous investors.
Definitely not. The price recently was around $2.01. Now, that's way up from the 52-week low of $1.25, so some recovery. But it's still so far from the high of $4.48. That huge range tells you the market just can't decide on a fair value.
Are there any positive technical signs?
There are some signs of accumulation, maybe. The stock has been making higher lows, bouncing off support around, say, $1.85 to $2. That's a level traders are watching.
But you got to remember the risk profile.
Absolutely. The beta is 1.89. That means it moves almost twice as much as the overall market, both up and down. It's a trader stock, really, looking for alpha on news pops, not a set-it-and-forget-it investment.
So key price levels to watch.
Well, it recently got back above its 50-day moving average, which is around $2.10. That's a small positive. But the big test, the real resistance, is the 200-day moving average. That's up near $2.95.
So getting above $3 would be significant.
Very significant, technically. Right now, you could maybe see a trading range between like $1.75 and $3.10. But to break out above, say, $3.20, it needs a real, solid catalyst. Strong news.
And we know exactly when the next big potential catalyst is coming, the earnings report.
Yep, November 10th, 2025. Q3 earnings. This is crunch time.
Why is this one so critical?
Because it's the first real chance to see if these AI deals like Perplexity are actually starting to show up in the revenue numbers. And just as importantly, are the cost controls working? Is there progress on improving margins on that deleveraging story?
So positive surprises here could really change the narrative.
Instantly. If they show AI traction and better cost management, that could blow up the whole bearish debt argument that's holding the stock back.
There's more coming in Q4 too, right? Something about an AI tool.
Yeah, they're expected to roll out some enhanced AI content tool or API integration later in the quarter, another step to embed themselves deeper into how people create content.
Okay, beyond the official news, what about rumors or other things moving the stock?
Well, there's always chatter. We've seen some speculation, totally unconfirmed, mind you, on forums about maybe a bigger strategic partnership, like with a major cloud provider or another big AI player.
Based on what?
People are pointing to language in recent press releases talking about strategic technology collaborations emerging Q4 2025. It's thin, but it fuels that hope for a massive upside surprise, making Getty even more foundational to AI.
And institutional investors. Are the big funds buying in?
That's something to watch closely after earnings. We'll get updates on institutional holdings, ETF inclusions or exclusions, probably mid-November through December. Seeing big funds increase their positions would be a major vote of confidence.
And zooming out, beyond the immediate AI buzz, there are longer-term possibilities too.
Sure. Things like growing more in Asia-Pacific, maybe some M&A down the line, leveraging that global brand over the next couple of years. The AI story is front and center now, but there are other avenues.
Okay, let's try to wrap this up. Analyst ratings are kind of lukewarm, mostly hold, you said.
The ratings themselves are cautious, yeah. But, and this is the fascinating part, look at the price targets. The consensus range is roughly $4.03 up to $4.76.
Wait, from a current price around $2, that's...
Over 100% upside potential. That's what the analysts see if the company executes successfully on this AI strategy and gets the debt under control.
So massive potential reward, but tied to massive execution risk.
Exactly. The risk-reward is compelling because of that underlying strength, that 73% gross margin combined with this huge AI opportunity. It really feels like they're at a turning point, an inflection point.
But we absolutely have to hammer home the risks one last time.
Cannot ignore them.
Yeah.
That huge debt pile. The fact they're still reporting net losses. If those AI revenues don't materialize quickly, or if the November 10th earnings disappoint, well, expect more of that wild volatility we saw after the Perplexity news.
So the path forward really hinges on this AI monetization. The company has the strong moat, the brand, the archive, that should be enough to eventually overcome the debt. But it all comes down to proving these AI partnerships can actually deliver the profits needed. That's the story to watch.